Hi, a very good evening to all of you. This is Priyadarshan Soni once again from McLeod Pharmaceutical Limited, bringing you the next session, the second session of the Damita's risk mitigation, financial risk mitigation series, uh, live from Mumbai. Today, I think it's going to be very interesting because last session we talked about wealth creation and why the money should not remain idle, neither in bank nor at home, not anywhere else where it cannot grow. Today, we bring you that part of risk mitigation series where it can grow the most, the fastest. And today, we bring you one of the most eminent speakers who can really take you and on a roller coaster ride to that aspect. But before I hand over to the speaker, today I would like to invite Mr. Sanjeev Sahu. He is currently with the McLeod's Pharmaceutical Limited, and he has done his post graduation in finance, and currently as an assistant general manager with accounts, and he handles the treasury and financial aspects of McLeod's Pharmaceutical Limited. He has 12 years of huge experience, and he has worked with both the companies which are currently hosting this show, the UTI AMC and the SBI mutual funds. So, by not taking much time, I would like to pass on the main anchorship to him, and so that he can kick off the second session in a very spirited way. Over to you.
Yeah. Thank you, Priyadarshan Soni. And first of all, very good evening to everyone. And first of all, I would like to welcome all of you for the financial risk mitigation series. And in last series, Mr. Deepak Mehta has explained the various myths about the wealth creation. And in today's series, we are going to discuss about the equity market and the stock picking ideas. For today's discussion, I would like to introduce one of the very well-known market analysts, Mr. Ambareesh Baliga. Ambareesh Baliga has a rich experience of more than 35 years, and he has worked with many reputed firms like Kotak, Karvy, Way to Wealth, Edelweiss, and he has added the business segment such as the wealth management, fund management, corporate advisory, and investment banking. And he is a regular author and the article of the Outlook Business and the Business Standard. And he is a guest speaker and to the CNBC Awaaz and G Business. We are regular viewer for the same. And he has also known for his out-of-the-box contrarian call, which is a part of the wealth multiplier opportunities. He has experience across all the sectors, IT, pharma, and FMCGs. And today we are going to share his view on the equity market, and he is going to explain how the market activities affect the specific stock and the sectors. Now I would like to hand it over to Mr. Ambareesh Baliga. Ambareesh.
Thanks, Sanjeev Sahu, for your kind introduction.
Yeah.
Honored to be on this platform. First of all, I should salute all of you and your colleagues for your fight against this pandemic and taking care of all of us. The most precious thing for all of us is not money, but it is life and health of each of us and our loved ones, which no money can buy. And you have the power to save that with your skills. And that I would clearly say is next to God. So thanks once again. Without wasting much time, let me straight away go to my presentation. So it's exactly been a year since COVID threat became real in India. Just when we thought it's behind us, we seem to be in the midst of a second wave, especially in Maharashtra, Kerala, Punjab, and a couple of other parts, which looks to be spreading too fast enough. Though as of now, the deaths, fortunately, the deaths reported are low. When we look back, most of us are wiser in terms of what the government. Audio is clear, isn't it?
Audio is clear.
Okay. So when we look back, I think most of us are wiser in terms of what the government should have done, as well as how we as investors should have reacted to the situation. But again, this is always the case. When we are in the midst of an extreme situation, we are always overwhelmed and we may act irrationally. And only later we get wiser due to the benefit of hindsight. So when the pandemic started, it was clearly the fear of the unknown. We just started having a few hundred cases and we went into complete lockdown. The picture which we had in mind at that point of time was high probability of death, so which is fear.
Yeah.
There was also a livelihood, a possible loss of livelihood for many. So that's the second fear which was there. So the market took it as if it's a doomsday event, since no living person had witnessed this sort of a pandemic, because this was happening after nearly 100 years. So there was no immediate precedence for the authorities to go by. So naturally, everything came to a standstill. Markets had one of the worst crashes in the recent memory. So Nifty came crashing about 40%. Next couple of months, the data showed that there's a high probability of survival. That's when the government as well as the citizens chose livelihood over life. So as the threat to livelihood was much greater than the threat to life. So we slowly started opening up from July, August, and by September, the daily cases were close to about 1 lakh per day, like you can see on the chart. But life was getting back to normal. The fear clearly had given way to caution. And then finally, it has given way to carelessness, now leading to another wave of COVID. Now, I would put a question to poll as to when did you start investing? So if you can just respond to that, we can just move ahead. Yeah, presentation has been sent. Okay. Yeah, I just do that. Oh, just a minute. हुआ नहीं हुआ ना?
No, sir, not yet.
Not yet.
Yeah, now it's visible.
Fine. Yeah. So here's a poll. We should have the results now in the next 10-15 seconds. Can you go ahead? Yeah. But then what happened during March to June? Most of the people were actually sitting at home. First, it was the shock, but then it was clear that life has changed and changed permanently. People would need to work from home. and stay at home, at least in the foreseeable future. Quite a few lost their jobs, and those who were employed initially had enough time on hand. College students didn't have to attend classes as online systems were being put in place. The retired folks could not go out since they were seen as a high-risk category. So overall, everyone was sitting at home, nothing much to do other than surf the net, watch OTT or the television. The only activity which went on without hindrance was clearly the stock markets. It was it was work as usual, and one could open an account and trade seamlessly without moving out of the homes. So everything was online. So as you see, we saw a record 1 crore Demat accounts being opened. And the power of retail was seen after a very, very long time. Imagine each investor starts with about 1 lakh, and over a period of time, because of the confidence he gains, he's investing, say, 3 lakhs. The collective strength, collective strength of this investment by the new retail investors, who are so-called Robinhood investors. This Robinhood term comes from a US-based broking firm, which is meant for the retail investors. So the total amount works out to 3 lakh crores. Just imagine 3 lakh crores versus the total amount FIs have pumped into the markets in the last 1 year is 2.67 lakh crores. So the new retail investors works out to more than 3 lakh crores. And if you take all the retail investors together, it's much more. So in fact, this market was driven by the retail investors and then the FIIs. Now with this, I'll come to the next poll. Question is, did you have the courage to buy during the crash last year? Karan, can I have the results of the poll? Can we move on? So as the markets bottomed out in about April last year, started moving up, all those who had invested fresh made decent money. Whether we call it beginner's luck or otherwise, the timing seemed perfect. And a few profitable trades led to further investment. Like I said, people started off with 1 lakh, and then you saw decent amount of profits coming in. So you got more confident, you put in more. People removed their FD, put that in the market. They got their friends and relatives interested, as making money on a daily basis seemed so easy that, and nobody really wanted to be left out. So once you heard your friends have made money, you also opened a Demat account, you opened a working account and started trading. You made money, so you told 10 other people. That's how, we had this 1 crore people coming in. And the best part is that the markets never really corrected. In the last 12 months, market never really corrected in a big way. All those corrections were very, very small. And whenever the markets corrected, everybody looked at it as if it's a festive sale. The stocks which had moved up, corrected a bit, it's a decent discount to buy it at, and they lapped up the shares. And again, they made money. So, meanwhile, you had the government, which came out with supportive measures. They announced various measures to improve the sentiments. Earnings had improved because we had the first quarter results, which anyway people didn't really expect it to be good, so it was written off. The second quarter results were much better than expected. The third quarter results also were much better than expected, so people thought it will continue. Because the earnings improved basically because clearly the costs had gone down. Overhead costs had reduced because people, the corporates have started cutting costs in a big way because of the pandemic. Plus, at the same time, there was a decent amount of pent-up demand which came up. And since the economy opened up around August, September, immediately after that, there was a festive season. So the festive demand also came in. So it was a great time for most of the companies, especially in the last 5-6 months. So it's been a dream run till last month, till February beginning. We saw it was a dream run, but after that, it's been more or less stable. It has not really corrected in a big way. Whatever we have seen in the past few days has been more of a small correction here and there, because when the market goes up to 15,000 levels, the 500-point drop is considered a small correction. It's not a major correction. But then what's driven this rally? This rally has been driven basically by liquidity. And again, it's been supported by better than expected earnings. Now, if you look at the sort of wealth creation this rally has given, I mean, anyone who was long has made money. So the wealth created in the last 1 year was US $1.5 trillion. Now, converted that into crores, it is 1,12,50,000 crores. Too many zeros. So like I said, since the last 1 month, the markets have been range bound. Last few days, we have seen the markets weakening. Now the question is, can this liquidity stop? Liquidity clearly is a friend of the trend. If the trend is positive, liquidity flows in. Because the liquidity flows in, you have the markets going up. So it's a virtuous cycle. But once every additional rupee which you are investing starts to give a negative return, that's when the liquidity stops and the cycle turns the other way. And this trigger can be anything. Like I'm giving my short-term view, I'm giving some pointers on that. And there are too many red flags, at least currently. Like all of us know, the second COVID wave is here right now, and we are in the midst of that. The bond yields are rising. So generally when the bond yields rise, and especially in US when the bond yields are rising, normally the FIs take the money back. Because the risk return clearly changes because of the yield going up. And especially from the emerging markets, money generally goes back. The oil prices, which were quite low during the COVID, during the first wave of COVID, but now the oil prices have hit about $70, and all of us know as to how much we are paying for petrol and diesel. So this will also increase the input costs for most of the companies. The inflation also is moving up. So all these are those red flags, which are those speed breakers for a bull market. Again, last 2 quarters, we are quite surprised by the sort of earnings which the corporates showed. So when you meet expectations or when you exceed expectations, then the future expectations also go up. So for this quarter, for quarter 4, the expectations are very high. And in case there's a disappointment, I think that can also lead to a correction. There are elections in a couple of states which are going on right now. So the outcome of that is another question mark as to which way it goes. Then the banks were asked to give moratorium to the borrowers. So the moratorium has ended. So we could see the NPAs also rising for the banks. And one important thing is, which most of us in the stock market are missing out, is the stock market has, say, about 4,000 to 5,000 listed entities, out of which about 1,500 to 2,000 are traded on a regular basis. But these 1,500 to 2,000 companies are from the premier section. They are the larger companies as compared to, lakhs of smaller enterprises which are there. So in this COVID season, what has happened is the bigger boys have become bigger, and the smaller boys, or we can say the smaller businesses, have actually suffered. So the pain is actually there in the bottom of the pyramid, which is not getting reflected in the markets. And unless that is taken care of, it's very difficult for the economy to grow at a much faster pace. Because when the economy grows, it has to take everyone along with it. But although I'm saying that short term, I'm a bit cautious because of all these reasons. That doesn't mean that for long term that I'm bearish in the market. Long term, I think looks extremely good for India. I mean, especially with this government, which has been very stable, forward-looking. Initially, they started off with that Make in India program, but then that has given way to Atmanirbhar Bharat, because clearly India cannot control what the world would like to buy on from where. But then I think it's clearly better to focus on the country's strengths instead of playing in areas where the global competition is intense. So Atmanirbhar Bharat means that let us be self-sufficient. Whatever we are importing, can we manufacture or build or do that in India? And I think this will ensure that our import bill comes down in a decent manner, even the oil bill. Because, I mean, although we don't produce enough oil, I mean, what is consumed in India, we are only producing a very small percentage. But I'll in fact, I will come to that later as to how we would be able to reduce our oil bill. So overall, we are looking to reduce our imports and be self-sufficient. So that will give a huge impetus to the Indian manufacturing companies, Indian corporates, and that will lead to a decent growth. We are looking at growth in corporate earnings over the next 2 years. I think FY22 earnings should be extremely good. I think it should be about 35%. FY23 could be about 18%, because FY21 the base is lower. GDP is also expected to grow at about 11% for FY22, and FY23 again should moderate to about 6 to 6.5%. Government yields, I mean, it should be around 6.5, 6.75, may not really go too much beyond that. But if you look at the central bank expansion which has happened, in calendar year 20, the combined balance sheet of the Fed, the ECB, and the Bank of Japan grew by nearly 55%, which means about, it grew by 55% to about $22 trillion. So clearly about $8 trillion was injected into the system. And where does this money go? I mean, a decent amount of this money has come to the financial markets. I mean, if you go back 10 years during the global financial crisis, I mean, the total size of these central banks was just about $4 trillion. And today it's $20 trillion. So clearly, this much of money has come into the system over the last many years. And a decent amount of that has come into the markets. The Indian government also announced a 20 lakh crore package, but then hardly about 1.5 lakh crores was in fact a direct injection. So one can say that Indian government was more prudent, didn't really, try to print more money, borrow too much money to make good of the slowdown. They gave other incentives so that the corporates and the manufacturing companies are able to bounce back. And if you look at India's theme, it is basically a consumption theme. It's clearly a consumption-based economy. I mean, during COVID, those first three months, we saw a huge demand for FMCG. Just to tell you, the most sold items during those 2-3 months was farsan, was biscuits and stuff like that. As soon as we started opening up, two-wheelers and cars were bought as if there is no tomorrow. Washing machines and dishwashers were the highest sold products in white goods. And finally, if you look by October, November, December, real estate, which was dead for the last 4-5 years, saw that the inventory is getting sold off, especially in the affordable housing. I'm not talking about luxury housing. And like I said, despite the geopolitical issues with our neighbors, the political climate seems extremely stable with a strong leader. And this is exactly what businesses and investors look for. Now coming to, how do you identify opportunities? So there are a couple of golden rules which are there, which I think should be applied by everyone who is looking to find a multi-bagger, a long-term wealth creator. So the first thing which we normally see for any stock which we look at is what is the competitive landscape? I mean, how is the competition around for, I mean, who are the company's key competitors? I mean, how large is the business possibility for that company? Then we also check as to, I mean, whether there's over-regulation of the business or not. Because just to give you an example, a telecom, I mean, there's too much of over-regulation. I mean, although it's, I think, one of the best possible businesses, but then there is over-regulation. You don't know as to when another sport will fall upon their head. Then we need to see whether it's a, I mean, how is the competition, like I said, whether it's a monopoly, oligopoly, whether there's a perfect competition or not. What is the bargaining power of the customers and suppliers? And like I said, I mean, if you compare the two businesses, say the paints sector and the telecom sector, and both are doing extremely well. But then in paints, there's not much of regulation. And because of which the sort of valuations which the paint companies are getting, like the Asian Paints or a Berger, is much, much better than what possibly a Bharati Airtel gets. But then during COVID, we saw that we can stay without painting our house, but we couldn't stay without having a broadband or a like telephone connection. The next important thing which one looks at is the management. It's always better to buy a good management in a sector which is not doing too well than to buy a bad management in a sector which is doing well. So management, the quality of management, I think, is of utmost importance. So one needs to know as to who the owner of the company is, because most of the Indian companies are promoter driven. Then one needs to look at the composition of the board as to how broad-based the board is, how many independent directors are there, and how many of those independent directors are really independent. I think that is most important. And whether the company is professionally managed or not, one can visit the company website, read about the background of the company out there, read the annual reports. There are enough number of investor presentations available as compared to earlier. Currently, lots more of investor presentations are available. The con call transcripts, and just I think 2-3 days back, SEBI came up with a diktat that any meeting the company has with any investor, including the large institutions, all the transcripts have to be they have to be uploaded. So which means there's a lot of transparency which is going to be there. And at the same time, there are enough amount of research reports like available on the company. So all these can be looked at. And when you look at the management, we clearly look for integrity and transparency, whether it's a full tax paying company or not, because when taxes are not being paid, then clearly there is something they are hiding. And at the same time, look at the dividend payout as to how healthy the dividend payout is. Do they have a dividend policy or not? So all these are decently important things to be looked at. And the other thing is how good the management has been at execution. So when you look at the past track record, you can make out as to what they have said and what they have delivered, because everything is now available online as to what they would have said in an interview about 4 years back. Has it been delivered or not? So those are the matrices which I think one should look at to decide whether the management is decently good or not. Then, do they really have a sound succession plan? I think this is more important in terms of professional managed companies. Like, for example, something like ITC. ITC clearly decides about 2 to 3 years earlier on how the succession should happen. Now we are seeing the succession plan happening in Mahindra & Mahindra, which has moved from from family owned and run to purely professional run, because Anand Mahindra is stepping down in the next 6-7 months, and it's being taken over by the CEO, a professional CEO. So I mean, these are things to be looked at, and whether the owners, if they are continuing, whether they have enough skin in the game. Then you look at the financials. I mean, is the company's business model, is it easy to understand? Can can you as an investor understand? If you don't understand as an investor, then I don't think you should be investing. There are so many other sectors to look at. Whether it really makes money, whether the company is profitable. When you say profitable, it also means the cash flows, because one can show that the company is making profits on paper, but not really, you're not seeing the cash flows. Then out there, a couple of matrices which we see is whether return on equity is greater than the cost of equity. Are the company's terms of trade favorable? Like I said, is the cash flow healthy or not? And when we say terms of trade is favorable, it's basically, we see that there's a reasonable bargaining power between the customers and suppliers. So the debtor-creditor ratio should be decently low. Then we look at the return on capital employed, return on equity, EBITDA margins. These are things to be looked at when you look at the financials. The fourth one is moat. So in moat, like what are the sources of the company's economic moat? A few things could be like a strong brand, which leads to customer loyalty. So, which again could be because of patents, it could be because of your wide distribution network or service network, proximity to possibly the key raw materials or the markets. Again, when we talk of moat, let me give you an example. Economic moat, which I said a bit earlier, it's like Maruti. They have 50% market share. There are so many brands, international brands which come into India. They have tried to dislodge Maruti, but they just couldn't. Maruti possibly came down from 65% or 70% market share to 52% market share, 50% market share, but they couldn't dislodge Maruti. And another company about which I'll be talking about is Pidilite a bit later. Again, the brand of Pidilite. It's very difficult to dislodge that. When you talk about adhesive, it's only Fevicol, which is the brand. You can't think of any other adhesive like Fevicol. Although there are, I think, 10, 15 other brands which are there, but no one remembers them. The fifth thing is clearly the leadership position of the company. Typically, one should look at a company which is among the top 5 in the sector, or at least in the sub-segment. If you're looking at a new leader who's coming up, possibly look at the sub-segment of the sector to see whether it's a leader in that sub-segment. In that case, possibly over the next 5 years, 10 years, it can be among the sector leaders. And when you're buying a equity, buying a particular company, there should be clearly earning visibility. So we should know what the company's growth plans are, how sustainable is that growth. And for that, you should look for whether they're going for capacity expansion, new product launches, whether there's a business diversification, are they expanding to new geographies, are they doing any mergers, acquisitions? And again, all this requires money. How is the funding being done? Are they borrowing? If they're borrowing, can they manage that borrowing or not? Or is it being self-funded? So these are a couple of things which are being looked at when you look at an opportunity. Then some of the common ratios which we look at is earning per share, which is net profit divided by the number of equity shares which have been issued. Then P, price earning, which you normally hear whenever any analyst is telling you, okay, buy this stock, they normally talk about P ratio. So P ratio is the market price divided by the EPS. And when you look at the P ratios, you generally tend to compare the P ratios with the other peer sets in that sector to decide whether it is worthwhile buying at this P or possibly wait for a correction. Then another important ratio to be looked at is price earnings growth, which is P ratio divided by the growth, the CAGR for the next 5 years. Typically, this should be less than 1. Only then can you really see the growth getting translated into wealth creation. Then the fourth one is return on equity, which is net earnings divided by the shareholders' funds. Like I said earlier, free cash flow is something which we normally check it out. Current ratio and the debt equity ratio. Current ratio is current assets divided by current liabilities, and the debt equity ratio is the debt divided by shareholders' funds. These are a couple of those things which were, I mean, like as an investor, one has to practice these, because knowledge alone is not enough. One should ensure that one is detached from the investments which you have, because I mean, if you're too attached to investments, you may not be able to exit at the right time. When possibly the markets are booming, and possibly that should be a good time for you to exit. But since you've been holding that stock for the last 20 years, or it must have come from your father, grandfather, you don't want to sell that. I don't think one should be attached to your investments. So detachment is very, very important. Patience and persistence. So when you bought something, don't really expect it to give you returns the next day. If it gives you returns in the next couple of days, extremely good, utilize it. But always invest for long term, because wealth is always created in the long term. And if you know what you have bought, if you have understood what you have bought, then I think patience and persistence can come along with that, because you won't get panicky. Ability to ignore general panic. So what we saw in March last year, April last year, I think one should develop that ability to ignore general panic. Otherwise, what happens is, just because people all around are panicking, you also panic and exit. I mean, I know people who have exited their portfolios which they built up over a long period of time in March, and they've never been able to get back, because once you have sold it at a particular price and the prices have shot up 30, 40, 50%, it becomes very difficult for you mentally to adjust and start buying stocks at a higher price. And generally, when there is panic, when there's a bearish phase, there's a lot of pain. I mean, you feel as to, I mean, why did I buy at those higher levels? I'm losing so much money. But then, as an investor, you should be able to tolerate that pain. If you're not able to tolerate pain of holding on to a loss-making investment, then market is not the place for you. And the fifth one, it's like similar to tolerance for pain, is that don't get unnerved by losses, because loss and profit is a part of the game in the markets. And if you know your company well, if you've understood as to I mean, why you bought that stock, and I mean, you're willing to wait, you have that patience, then I don't think you should really get unnerved. I mean, have that positive attitude. And all this can happen only if you're willing to do that independent research. Do not buy anything just because someone has told you to pick it up. Try and do some independent research. You may not be an expert like any analyst. I mean, that's a profession of an analyst. You have a different profession, but still, I mean, there is common sense which can be applied. You can read up articles, you can read up the research reports. So do at least some independent research before picking up a stock, and always keep some cushion. Do not invest all that you have to invest in equities at the same time. See, I mean, keep some cash on the side, because you never know which is a rainy day. And very important that market is the biggest teacher for all of us. I mean, it's on a daily basis we keep learning. So willingness to learn, to admit mistakes and learn from them. So this is the normal behavior for investors in any market cycle. So the optimism which is put out here is say around May, June last year. Markets have gone up. You've invested fresh. That initial excitement is there. then it's gone up much more than you thought. So you're getting that thrill out of it. And still going up further, euphoria, which is what we have seen from December to Jan, early Feb. Then we have seen some correction, but there's a bit of anxiety, not really too much. Then it comes down further. Then you're in denial. You say, no, doesn't matter. I'll hold on. I mean, this like the last 8-10 months, I've really seen the markets going up. It can't come down so much. So this is only a correction. Let me just hold on. So you get into denial. Well, the markets don't go up at all. It's still coming down. That's when the fear sets in, and fear leads to desperation, and then you have the panic. And this is the time a lot of people panic and exit the markets. So exiting the market is capitulation. You give up. You say that anyway, this market is not meant for me, or I'm not meant for the market. And there's complete despondency. You say, no, there's nothing left in this market. No one really should put money into the markets. Keep your money in a fixed deposit in a bank. That is despondency. And then you get into depression. But then, after every sunset, there's a sunrise and a fresh hope, relief rally, and back to optimism. But the only issue out here is the people who were there in the first cycle, quite a few of them exit the markets permanently because of that despondency and depression. They don't come back and they don't become a part of the next cycle. I mean, most of the cycles are led by new investors. So going back to my earlier slide, where I said, what are the things as an investor you should keep in mind? If we keep all these things in mind, at least follow a few of them. It's not possible to follow all of them. Try and follow a few of them so that this ensures that you're there in a number of cycles and you are not an investor just for one cycle. Now here I'll just discuss about my learnings as a investor. I've been in the markets now for about 35 years plus. What I've noticed is that market is a game of psychology. You may have the same knowledge, in a sense, 10 people may have the same inputs, but they may not get the same sort of returns. Because clearly depends on how you are behaving in the market, how you are reacting to various situations. So as an investor, I think you should have a very clear mind. Basically, keep things simple. Keep your life as simple as possible. Throw out the noise. Try and walk alone. Because if you're walking with a crowd, you also fall with the crowd. And for me, investment is not money. Although when you talk about investments, you always talk in terms of money. But what I require for my personal consumption is kept separately. What the balance, what is to be invested, I don't think of that in terms of money. For me, it's only figures. Because there are days when your portfolio can come down, like a decent amount, and you may think that, okay, oh, I could have bought a car with that. I could have gone on a holiday with the amount I've lost in one day. I could have done a foreign trip with that. So you normally try and compare when you think it is money. But when you think it's a figure, then your focus is much more clearer. Today it's 100, your target is 130. How do you achieve it? Then a lot of people say that you guys are in the market, you'll get so much of information. You people are at a much better position than us because we don't get inside information. Anyway, inside information is, again, banned as far as, by SEBI. So no one can really utilize inside information. But let me give you, what had happened about, say, 20, 25 years back. I had invested in a stock like Satyam, which is anyway now merged with Tech Mahindra. I think all of you know about as to what happened to Satyam, the scam. But this was about 25 years back. It was an upcoming company. I bought it at about 40 rupees. And then being in the market, I got to know that they have defaulted on a loan. And I sold off. So that was too much of information. The information which was not really there in the market with a lot of people, I got to know about it. So I just decided to sell off. But the same stock from 40, it went to about 8,000. And I never really got to buy it back. So too much of information need not be good all the time. Again, unlike all these Robinhood investors, early in your investment career, I think one should lose money. I think that's the best way to understand as to how the market works. The fortunate ones, in fact, go bankrupt. In a short to medium term, you're actually pitted against those whose collective thought processes drive the stock and not the real fundamentals. Like what you're seeing right now. I mean, I don't think right now it's the fundamentals which are driving the markets. It is basically a whole lot of retail investors, possibly as well as institutional investors, who are just buying just because a certain number of stocks are moving up. But then this is not really driven by fundamentals, because fundamentally, if you look at it, most of the stocks are looking extremely expensive, but they still continue to move up. But then this can happen only for a while. It can't just continue for too long. Another important thing is never regret. You may make a mistake, but never regret, because the amount of time you spend on regretting, you actually lose out on opportunities. And market is the only place where every day it's a new opportunity. Investors talk about long-term investments. There are traders talk about short-term investment. But I've personally seen that there's a lot of gain to be made in the medium term. You buy for long-term, don't buy for short-term. As an investor, you're supposed to be buying for long-term. But utilize the sort of moves which happen in the medium term and utilize those moves in the sense, for example, if you bought something today to hold on for the next 2 years, you're having a price target, you bought it at 100, you have a price target of say 160 in the next 2 years. But in the next 4 months, if the stock goes up to 140, it is prudent to book out to a certain extent, because what you're expecting in 2 years, you're getting in 4 months. Why not utilize it? And I'm a strong believer in the greater fool theory. The greater fool theory states that the price of an object is determined not by the intrinsic value, but rather by irrational beliefs and expectations of market participants. And today, I think the market is full of greater fools. Time to give away your investments to those. When I say investments, I'm not talking of really those blue chip investments, but there will be some mid-cap companies which you have bought, which have become multi-baggers today for you, or some stocks which you had bought, say, about 5-10 years back, penny stocks, they were not moving, they've started moving now. Don't think that there's a new story building up in that, unless you're very sure. If you have just heard, and if you've seen that these stocks have moved up, it is clearly a time to give it to that greater fool. Are the polls working? Because I've not got the results for the earlier 2 polls. So this poll is about how many times in the recent past have you bought based on tips without trying to understand what the company does. Do we wait for the results or go ahead? Okay, I'll go ahead. So a lot of you would have heard about operators. Now, is everything as transparent as we believe in this market? Because see, every sector has its dirty secrets, including the stock markets. And I'm talking about all this not to scare you, but so that you are cautious and don't believe anything and everything which you hear or read. So the first is about operators. I'm quite sure you would have heard that ये tip आया है, वो tip आया है, ये ले लीजिए, अच्छा लगता है. And you tend to buy it without thinking twice, because the last 2 or 3 times the person who's given you the tips have worked out. So the third time, I mean, last 2 times you didn't buy, but you've seen the tips have worked out well. So you buy it this time. But then quite a few of the stocks are operator driven. They are driven by a bunch of people and may not be really backed by fundamentals. So here we don't know as to the person giving you the tip as to in which circle he is. If he is the closest circle and he's very close to you, possibly he's giving you the tip early, but more often than not, the tips which come out like this are generally in the last circle. So that is where you buy and the stocks come down, because they need someone to offload the stocks to. And the best people to offload is the retail. So please don't go by whatever tips which come, because there's nothing called a free lunch in this market. Then I'll talk about how circular trading happens among larger investors. At least this used to happen earlier. I would like to comment whether it happens now. And I'm again not talking of any fund or any stock. I'm just talking of 4 investors. Again, they are not holding stocks, they are holding fruits, oranges at 10 rupees, apple at 10 rupees, bananas and pineapples. Each of them are holding different fruits. So investor A pushes the price of oranges to 20 and sells it to B. B sells the apple it has, which he had bought at 10 rupees, at 20 rupees to investor C. And similarly, C sells bananas to D, and D sells pineapples to A. So everyone who started off with 10 rupees is today showing a NAV of 20 rupees, because now A has pineapples worth 20, B has oranges worth 20. So similarly, C has apples and D has bananas worth 20. And again, the same thing happens. This again sell to the next person at 30 rupees. And the same thing happens again, 40 rupees. Now, what is the NAV? NAV is 40. What is the original price? 10. Any new investor who wants to come in and say that, okay, you guys have made 10 rupees, 40 rupees, let me come in and invest in you. So at what price does he invest? He has to come in at 40 rupees to invest, because these people will not allow him to invest at 10 rupees. 10 rupees was a couple of months back. Now the NAV is 40, so invest at 40. So these are a couple of things which happen, which generally doesn't come out too much in public. Then why do you think corporates manipulate? Because there are corporates who like the stock price to go up. One is there's a direct monetary gain. The wealth goes up for the promoter. End of the day, promoter is the biggest shareholder of the company, so his wealth goes up. So at the same time, once the market capitalization moves up, when the price moves up, the market capitalization goes up. They are able to raise funds at the higher price, which means you're raising funds much cheaper than what it was. Because say the stock was quoting at 50 rupees, you needed to raise say 50 lakhs, you would have had to sell 10 lakh shares. No, you would have to sell 1 lakh shares or issue 1 lakh shares to raise 50 lakhs. Yeah. But then your price goes to 100, you have to raise only 50% of that. you have to liquidate only 50% of that. So fundraising is one. Then status and ranking, because if your market cap is say 500 crores and you're meeting someone else whose market cap is 10,000 crores, clearly his social standing, his ranking is much, much higher than yours. So to improve your status and ranking in your social circles also, you need to have your market cap going up. So those are a couple of reasons why the managements or the promoters tend to manipulate. And the cost of manipulation is clearly inverse to the price earning multiple. So, for example, if your price earning multiple is say 20 and your EPS is say 5, if you increase your EPS from 5 to 7, your price can go from 100 to 140, applying the same multiple. Now I'll talk to you about the structured GDR, what is to happen. I mean, all these are negatives, but generally I like to talk about it just to caution people that whatever you see, whatever you hear, take it with a pinch of salt. So the structured GDR is where the company issues a GDR, but the GDR is applied to by an investor who otherwise is an operator. He puts in the money into the company, gets the GDR. The money which is put into the company is given back to him via a subsidiary. So this becomes a net zero cost to the operator because he's got his money back. The GDRs were then converted into shares, and the shares were sold in the market. Just because the GDRs were being issued about, I would say, 8-10 years back, I mean, that was a very positive event. So the stock prices to go up and the operators to offload the shares in the market. And they should divide the spoils. The promoter and the operators to divide the spoils. And just to show you the chart of two companies which had issued the GDR, we just see the movement of the stock before the GDR issue and just after the GDR issue, and then where the stocks have gone. This is about using the long-term capital gains, which had become tax-free in 2006, if I'm not wrong, about 14, 15 years back. So when they became completely tax-free, people utilized that to get the funds lying abroad back into India. Say, for example, a person had enough funds lying abroad. He didn't know how to bring it back to India. What he would do is he would buy a very small company, which is basically called a shell company, which is listed. He would buy possibly 95, 98% of the equity of the company. And then, say it was quoting at, say, 1 or 2 rupees, because most of these shell companies quote at absolutely major discounts. And then try and push the markets up with news items, cooked up accounts. He would use possibly the PR, I mean, he may do PR activity, because of which a lot of news flows out in the market, information flows out in the market that this company is doing extremely well. And because of which the stock is to say move up. They would push up the stock, say, from 1 rupee to 100 rupees. That is the time he would transfer those funds which are lying abroad to a FII sub account, and that FII would buy the stock at 100 rupees on the Indian stock markets. So when FII buys, the promoter gets the money and the shares are transferred to the FII. And people still think after that since the FII is bought, the stock should go up further. But in reality, the FII was only used to transfer the money. And because the long-term capital gains were tax-free, this person could bring money from abroad to India without paying a single paisa tax, except for the spend which he makes to create all these news items and do all this activity. But then, like I said, a lot of negatives I've told you, but there are a lot of positives also in the market. And we have seen some wonderful wealth creators. The first wealth creator I would like to talk about is Pidilite, like a very strong brand which we just discussed earlier on Fevicol. That acts as a moat. Super innovation track record. It always keeps ahead of its competition. Excellent promoters. Till date, I don't think there were any controversies. Very clearly an independent board of directors. Return on equity is about 26%. PAT has been 20% CAGR for, I think, the last 15, 20 years, if not more. And the stock returns also have been about 25% CAGR for the last 25 years. And just see, even in the last 10 years, it's been what? 8, 10 bagger. Bajaj Finance. This started moving up only in the recent past, in the last 5 years. Again, a very good pedigree. Took advantage of the vacuum created by the PSU banks. PSU banks started having issues around 2014-15. And that is the time Bajaj Finance came in and captured the complete retail market. They have today close to about 5 crore customers, adding about 25 lakhs every quarter. Continuous improvement to their product features. They've used digital technologies to the maximum to stay ahead. They've been investing in analytics, again, to cross-sell the products. Their AUM growth has been about 25%. And we look at the PAT, 24% CAGR. Return on equity is about 20%, very low NPAs. The other wealth creator, again, from the financial field has been HDFC. It had the first mover advantage, no doubt. And when you talk of corporate governance, which is the buzzword now, HDFC is called the gold standard of corporate governance. It's been among the first few to offer ESOPs to its employees. So they've created a real world-class professional organization, which is the reason why HDFC is what it is. And if you look at the shareholder list, there's no promoter. 90% of it is held by various institutions. And mostly, I would say about 74-75% is held by foreign institutions. Low NPAs, despite the upheaval which we have seen in the real estate sector. We have seen Dewan Housing going under because of bad debts. But somewhere like a HDFC, hardly any NPAs. Stock has returned about 19% over the last 25 years. PAT has been growing at 22%. The revenue has been growing at 26% CAGR. And the return on equity is about 17%. Again, from the same segment, Kotak Mahindra Bank. Again, I've been an employee of Kotak Mahindra. I've been one of the initial employees. I joined them in 91. I left them in 2001. And I've seen good sort of a growth even during that period. But the major growth came once it became a bank. So despite not being the first mover, it's become a leader in each of the businesses it's been. And this is a promoter-driven bank, but professionally managed. Knack of being in the right place at the right time. Whether it was merchant banking or whether it was broking, whether converting into a bank, they've been doing all these things at the right time. So they were at the right place at the right time. They've grown consistently through strategic partnerships and mergers and acquisitions. That's the way they have grown. Whether it was a strategic partnership with Ford, whether it was a strategic partnership with Goldman Sachs, all through they have tied up with the best in the sector. The stock returns have been about 21% over the last 25 years. PAT has been growing at 22%. Revenue has been growing at about 21%. And the return on equity is about 13%. And one in the chemical sector industry has been Aarti Industries. Again, I wouldn't say it's family driven because there are three from the family, but the promoters are also, they have their friends also as promoters and technocrats, chemical engineers who had built this. So they are leaders in benzene derivative chain. and the lowest cost quality producers with excellent global customers. They are in fact the largest in that in the benzene derivative chain. They've got into toluene value chain also now. As a policy, 75% of the profits are plowed back for capex. So that ensures that the growth continues. Like I said, led by technically sound promoters, stock returns about 20% in the last close to 15 years. PAT has been growing at 18% CAGR, and the return on equity has been about 18. So again, in the last 7 years, 6-7 years, this stock has been what, a 6-bagger, 6-7-bagger. Now, pharma overview, since all of you are from that space, and just to tell you that pharma, I think, is one of the toughest sectors to be tracked for any analyst. I don't claim to be an expert in pharma. In fact, I'm also using a pharma research analyst who's a specialist in that sector. Because, like I said, I've been trying to understand pharma for a very long time, but just been able to cover just on the top. Looking at this chart, clearly, the last 20 years, we have seen this sector growing at about 18% from 2001 to 2010. I mean, that was the decade when the Indian pharma companies were really discovered by institutions. They really started going globally. And that's one of the reasons why we saw that huge growth in one particular year, 2004, we saw growth of about 41%. But after that, there was a slowdown in the next decade. In the last decade, it slowed down to about 8.5%. And especially the last 5 years have been pathetic. We have actually seen that the pharma sector overall had underperformed the markets. It just grew about 6.2%. Again, this has been driven by industry leadership supplying generic formulations to markets across the globe. But from now on, I think the next 10 years, the sector growth should be stupendous again. Because currently we are at about $42 billion and expected to grow to about $130 billion. So which means about 13% CAGR, which is very much possible because we have also done that in the past. And especially post-COVID, I think the world is looking at us as the pharmacist suppliers. So how does the industry stack up? I mean, the biggest export market is United States, Western Europe, Russia to an extent. And I mean, out of the $42 billion for the Indian pharma industry, about $20 billion is of exports and about $21 billion is what is sold in India. I'm sorry, so this was the chart. Now, looking at the India pharma landscape, it's basically the lifestyle therapies which continue to outperform, which is anti-diabetic, cardiac, central nervous system, and derma. I think these are the 4 last therapies in India. And if you look at diabetes, there are about 7.5 crore patients, making it the largest lifestyle therapy. Indian diabetes population is actually growing at about 3 to 4% per annum and expected to reach about 10 crore mark by 2030. Again, when we talk of blood pressure patients, it's about 20 crore. And in the US, it's about 8 crore people, which is 1 out of every 3 adults. When we talk of central nervous system drug market, that's about a $60 billion market and has been growing at about 9% CAGR. This again, I'm talking of the world market. Then derma is the second fastest growing therapy segment in India, just behind anti-diabetes. So India is clearly seen as a pharmacy for the world. Exports from India cover about 20 to 22% of the world's population. But then when you look at the total turnover, it's much lower, basically because we are at the lower end of the price point. We cover about 60,000 brands and 60 therapeutic uh, classes. 7 Indian companies are among the top 20 global generics, and 50% of DMFs are from India now. When we talk of the AIDS drugs, about 80% of the global demand is supplied by us. India supplies about 40% of generics of the US markets and about 25% of prescription drugs in UK. And global vaccine, about 60% is supplied by us. So global formulations value is about 652 billion, and overall market for pharma is about US $1 trillion, and it is expected to go to about 1.3 trillion by about 2030. Today, like I said, India's total share in exports is quite minuscule. It's about 2.1% because we are at the lower end of the price point. But by 2030, hopefully we should see our share rise to about 6%, about $78 billion. Now, where are the opportunities to grow the value chain? Clearly, expansion beyond generics, exploring opportunities in biosimilars and NCEs, which is new chemical entities. India's dominant share in the overall ANDA proposals, and for the first time, ANDA approvals by US FDA is a good reflection of the company's strength, of the country's strength in the global generics market. Indian companies have received over 35% of the total ANDAs approvals in the last 10 years. Now, again, India could be establishing itself as a global innovation hub. Again, this can be done through various collaborations. Build up your API capability to improve self-sufficiency, as well as achieve competitive suppliers of key APIs and key starting materials globally. And government again has notified an incentive scheme for this API manufacturer. So hopefully this should happen. And post-COVID, we've been seeing a reorganization of supply chains worldwide. Earlier, I mean, most of the companies were dependent on China, but now we are moving on to China plus one, and that plus one can be India. Another large opportunity which possibly could be coming up is the nutraceuticals market, where worldwide it's expected to grow to about $336 billion market by 2023, which is a CAGR of about 7.2%. Indian nutraceutical market is growing at about 21%, and we should reach about $11 billion, which is comparatively small by 2023, which is about 3.5% of the global market share, and we should be about $18 billion by about 2025. So government has been giving it a push, like through National Health Mission, Poshan Abhiyan. I think all this should also contribute to this growth. But most important is post-COVID, we have seen a lot of people looking at nutraceuticals, basically for their diets, to basically supplement the diet. And I think the other big opportunity which should come up is, which again, not too many people are talking about, is the COVID's aftermath. Because COVID may leave a long-term after effect on the patients with common symptoms like fatigue, shortness of breath, cough, joint pain, chest pain, muscle pain, all these. And this could be lifelong. And I mean, what we understand from whatever we read online or in discussion forums is there can be a damage to heart, lungs, and brain. Again, this is not claimed to be backed by clinical research, but this could be a possibility. And for the pharma sector, this could be another huge opportunity. Now, I'll quickly go through the stock picks which we have. I think I've already run too much beyond my allotted time. The first pick is Praj Industries. This is actually an exploding universe because ethanol is the big story. It has been a good story in the past 15 years, but it has not really grown the way it was expected to. But now the government has really mandated that 20% mixing should happen in petrol. This is being done to reduce the fuel bill, and currently only 6% is being mixed. So which means the capacity in India has to go up about 3x, and that too in the next 4 years. So that's a huge opportunity for Praj, because they make the machinery and the technology for making ethanol, and they have a 70% market share. And earlier there was a constraint that only if you're making sugar could you make ethanol, but the policy has been changed to convert sugarcane to ethanol directly. Biogas again is another huge opportunity for Praj, which it had researched and come on with the technology for compressed biogas, and that's a 1,75,000 crore opportunity. There's a capex out of which a share of that is used for your biogas plant. So which again should come to Praj. They are into wastewater management. They are into high purity water solution for pharma, and excellent balance sheet with zero debt. And the last 10 years, the stock has not gone anywhere. The turnover has been about 1,000 crores. But now I see an explosive growth happening for Praj. So this is one stock which one can possibly buy and hold on for the next 4-5 years. It can be possibly a multi-bagger from here. The second one is from your field, Eris Life Sciences. This is the youngest company among the top 25 in India, and it's the fastest. I would say the fastest. It's among the top brands in the fastest growing therapies like anti-diabetes, cardiac, and CNS. Eris is among the top 10 brands. They, in fact, plan to enter the insulin market over the next 2 years. And if you look at the revenue, EBITDA, and PAT growth, it's been about 20, 29%, and 34% in the last 8 years. So consistent growth we have been seeing. And superior profitability in terms of EBITDA margins about 37%, return on equity about 25%, almost debt-free. So Eris Life Sciences, I would see it as a new leader coming up. And maybe in the next 5-8 years, it could be among the top 10, top 5. My third pick is ITC, where I'm playing for value redemption, because this is one stock which has, the company has been doing very well, but it's not been really getting that valuation. Basically because of the ESG norms, where because of their cigarette vertical, a number of funds are not really willing to buy this because it doesn't fall under that ESG norms. Although it's professionally managed among the top brands in India, the fastest growing FMCG portfolio. In fact, they're aiming to be the largest by 2030. They're looking at 1 lakh crores of top line, whereas HUL currently is about 40,000 crores. So by 2030, Hindustan Unilever may be smaller than ITC. Large presence in the agro space, hotels, specialty paper, packaging. Extremely good dividend yield. 4.81% dividend, and the payout is about 65% of the profits are paid out as dividend. So instead of keeping money in savings account, one can actually put money in ITC. Return on equity has been 25%. EBITDA margins have been about 36%. So I'm expecting some sort of a solution from the ITC management on this, in the sense, and the only solution could be demerger, where you keep the cigarette business separate and the rest of the business separate. The rest of the businesses will get much better valuation as compared to what it's getting now. And that is what I think would be the wealth creator for investors. My fourth bet is a boring one, but a very safe bet. IRFC is a financier for Indian Railways. But if you see the growth over the last 6 years, it's grown nearly 10 times. 11,000 crores of disbursement in FY15, and now it's about 1,13,000 crores of 1,30,000 crores of disbursement in the last year. And the growth continues. It's about 26% growth in the last quarter also we have seen. And this is possibly the only finance company which doesn't have any NPAs and cannot have NPAs, because it supplies only to railways, which is as good as government. But it earns about 35 to 40 basis points returns on every rupee it lends. And there's absolutely no risk. AUM should be about 3.75 lakhs crores. I mean, should cross that very soon. They have an extremely good dividend policy, a minimum of 30% of profits of 5% of net worth. So dividend yields should be about 8.5%, which again is much better than what your fixed deposits are giving you today. And expected book value in FY23 should be 32. The stock is quoting at about 23, which is a 30% discount. So a decent upside is possible along with a good dividend. And my last pick is Bharat Dynamics. So clearly, the defense manufacturing is under focus. And because of Atmanirbhar Bharat, which we discussed earlier, like if you look at the growth over the next 4 or 5 years, I think it should be stupendous, much better than what we have seen in the past, even 10 years. So they started off with the anti-tank guided missiles and diversified into underwater weapon systems and air-to-air missiles, torpedoes. So in fact, they are the preferred suppliers to Indian armed forces. And defense market overall is about 1.8 lakh crores and expected to grow at about 5% maybe for the next 4 or 5 years. Recently, the Cabinet Committee on Security has allowed, I mean, earlier they could not export. And their major your buyer or the only buyer was Indian Armed Forces. But now they can sell to any other army which is not an enemy, but they could sell Akash missile to other countries. So I think that's a big opportunity which is opening up for Bharat Dynamics. And also there's an import embargo has been imposed on various defense items. So because of which the demand from the Indian Armed Forces for Bharat Dynamics should be higher than what we have seen in the past. Return on equity is about 22% and a healthy 29% dividend payout. EBITDA margins is about 24%. And the stock should quote at about 20 times EPS for FY22 of 24 rupees. So I think the stock can go to levels of about 480 or maybe much higher if one can hold on. So with this, I'll open the floor for Q&A.
Yeah.
So it's been a very long one.
Yeah, no, that's a good one. So there is one question from Dr. Anandan Krishnan. He just want to, if you can just elaborate about the GDR.
Oh, GDR.
Yeah.
Okay. So GDR is a global depository receipt. This is when the Indian companies were allowed to borrow overseas. So there are two instruments which are there, GDR and ADR. So ADR was American Depository Receipt and GDR was Global Depository Receipt. So where the investors invest into the GDR, which is quoted overseas, but it can be converted into the Indian shares at any point of time. So in this case, the one which I explained to you, the company issued the GDR and the GDR never traded in the overseas market. The investor immediately converted that into the Indian shares and sold it in the Indian market.
Yeah.
Yeah. So that's how he raised the money immediately. Whatever, first of all, the GDRs were free for him because he got his money. And when he sold, all that was extra. That was all the cream which he got, which they divided between the promoter and the operator.
Thank you, sir. And there is another question from Mumbai. The question is that everyone know the price of the stocks. They can see in the portals and everywhere, but nobody knows the value. So the same to identifying the value stock. So we need to same apply the golden rules, or is there any other techniques to identify the value stocks?
Yeah, see, I mean, the golden rules are universal.
Okay.
So, I mean, whichever stock you are looking to buy, you should apply this. The same rules. But say for example, a company which is just about starting to do well, you may not see that. I mean, most of the ratios which are looking out there may not be in line with the completely mature companies. So I think you have to give that kind of leeway. But once you are very clear that I mean this company, the overall universe for the company products is much larger, and they have a clear path to reach there. I think that's the time you should be able to take that risk and take that call and buy into them.
Okay.
Because see, whatever said and done, the large blue chip names will give you consistent returns, no doubt. They are very safe bet. They'll give you consistent returns over a period of time. But big money can be made in these mid-cap companies which become large cap.
Yeah.
So when they become large cap, that is the time you make that huge returns.
Yeah.
But then, like I said, it could be a bit risky also. You need to be able to take that risk.
Yeah. So one more question, like in the ratios, you have explained the P ratio. So somebody, if you look at the P ratio, the higher P is good, or is there any range for the P?
No, for a sector, there is a sort of a range. But then again, it differs from company to company. For example, in FMCG, you may have a HUL or a Nestle quoting at a much higher P.
Yeah.
And historically also, if you see, they have been quoting at a higher P as compared to a smaller local name. Because the difference is that Nestle or HUL, the management is considered much better than possibly the smaller company which is promoter driven, where the management quality may not be as great, maybe quoting at a lower P. So you cannot say that just because HUL is quoting at a higher P, there's a huge gap between this and HUL. Let me buy it. Let me, since this stock is quoting at a much lower P. But there's a reason for that.
Okay.
So one cannot go blindly by P ratios and say that just because the P ratio is low, I'll buy that.
Okay. So you should go with the industry average and compare it.
If you look at the industry average, you should try and understand as to why it is quoting at a lower P. I mean, historically, if you see that this stock has been quoting at a higher P, it's come down now, there may be a reason. And once you know that reason and you see that those things have been sorted out, and you can see a P expansion going ahead, that is the time you buy.
Okay. Sir, one more interesting question from the audience. They are saying there is a lot of volatility in the equity market we have seen from last 1 year. So now there is a like Nifty we can see is around 14,500 level. So this is a like you have given a stock picks and the wealth creation ideas and all that. So this is the right time to buy these all the equity shares, or should buy in a SIP mode? What is the strategy for the retail investor?
See, the market is extremely volatile, no doubt, and markets have to be volatile most of the time.
True.
And again, one can only have a view that the markets will correct or whether markets will go up. Finally, the markets have a mind of their own.
Yeah.
So, although my view currently is that the market should correct, and there should be a decently deep correction from here before it again starts to move up in the longer term. But one cannot be 100% sure. So, from that point of view, I would say that you can start buying, but I mean, buy it in various tranches. So, if you want to buy 100, buy possibly 20 now, and spread out the balance 80 over a period of time. As and when the market corrects, you can buy more. Or in case the market does not correct over the next 2 months or 3 months, then continue buying.
Okay.
So in short, better to go in for a SIP.
Done. So these all that's all from the Q&A side. And finally, sir, I would like to thank you for your view on the equity market and for the golden rules and the investor sentiments and the very interesting like fool's theory and the operator's ring and the wealth creation ideas and the stock picks. Thank you so much for your ideas and all that, sir.
Thank you, sir. It's been a pleasure. And I just hope I've not scared all your viewers.
No, these all are the interesting talks, sir. Yeah, thank you so much.
Thank you.
Yeah, before we closing, just like to announce Tuesday, we have Tuesday on 30th March, we have a risk profile. Yeah. Yeah, before closing the session, just to update, Tuesday we are going to have our third session on the risk profiling by Mr. Ajay Mittal, who is the head of training and the knowledge management from the SBI's fund management side. And before logout, it's a request to everybody to fill the feedback form. That is more important for all of us to improve the portals and the speakers, everything. Thank you so much for your patience here.